Welcome to our panel on affordable housing. Really excited to see you here. We're excited to be here. I'll say it's a true delight to be among some of the best and brightest minds to talk about social enterprise. So you guys give yourselves a round of applause just to get the energy going. We do have an all-star panel for you this morning. I'm looking forward to getting these ideas out to you. But before we do, I'm going to spend about 4 minutes on affordable housing. Could I get a show of hands of those of you who've worked in affordable housing so that we know, get a temperature for the room? Perfect, perfect. It's good that we see. So I'll give you, with that said, I'll give you a little bit of a basic framework for affordable housing, and I promise I'm going to get this panel to you as quickly as I can, but I just want to make sure we get on common footing. At a basic level, affordable housing are defined as housing costs that do not exceed 30% of a household's income, no matter the income level. So hopefully most people in this room live in some sort of affordable housing. The social agenda arises when a critical mass of people can't afford affordable housing. Of important note, and I'll mention in countries such as the US, Australia, South Africa, and other nations where race plays a role, affordable housing is obstructed by a legacy of structural racism as well. In the US, from slavery to Jim Crow, to redlining, school segregation, mass incarceration, to environmental racism, policies have consistently impeded or inhibited opportunities for African Americans as one population whose average wealth is 1/10 of that of white Americans at every income level. But why do we care, right? Who cares if there are piles of people sleeping on the streets, living in substandard living conditions? Where is it written that we should care? Well, I'm glad you asked. The UN Universal Declaration of Human Rights that will celebrate its 70th anniversary next month essentially holds that every family has a right to decent housing. Eleanor Roosevelt was chairwoman of the committee who made this declaration, so I'd say that we as a nation are in agreement with our international community on this one. In New York, the housing gap is enormous. 45% of our households, that's 45% of our households in New York spend more than 30% of their income on housing costs. 25% of our households spend more than 50% of their income on housing costs, right? So we have 3.1 million households in New York City. If you take just 25% of 3.1 million, that's 775,000 households who are severely rent burdened, and that does not count the homeless, the 55,000 homeless people sleeping on the streets tonight. So we have a glut of housing, affordable housing demand just here in New York City. Now, we lose about 20,000 units of affordable housing every year to deregulation or substandard living conditions. Just last year, for the first time, our administration has committed to a plan to producing a bit more than we're losing, with Mayor de Blasio's plan to produce, to increase the 200,000 units over 10 years to 300,000 units over 12 years. That's 25,000 units per year. So finally, we're committed to producing more than we're losing, which is great progress. However, that is not supply meeting demand. That's supply keeping up with supply. So we have a lot of work out ahead of us. But what if it doesn't make economic sense for you or I as private folks to do anything about it, right? That's what we call market failure. That's resulting in blight, crime, wasted tax dollars. But as Henry Ford has it, failure is just an opportunity to begin again, this time more intelligently. And a public and private capital framework has developed to address this condition. And it is that capital framework that will be the focus of our panel. So let's get to the panel, shall we? Ladies first, to my left. In very brief introductions, you'll have their bios in front of you, but I'll give a very brief introduction and we'll get right into Q&A. Lauren Zullo, Director of Environmental Impact at Jonathan Rose Companies, a leader in green development. We have, to my left, It's great because you guys are all sitting in order. Muzzy Rosenblatt, who is president and CEO of the Bowery Residents Committee, a leading innovative nonprofit offering services to people who are homeless in New York City. And Hugh Frater, CEO of Fannie Mae, a leading source of financing for mortgage lenders, making sustainable home ownership and workforce rental housing a reality for millions of Americans. Please give our panelists a round of applause. So we're going to start off with you, Hugh. Hugh, why don't you give us a sense of how big is our crisis in terms of the service gap? What is the cost of doing nothing? And what are our social impact metrics?
Well, thank you for that. There's some slides that I think are in your packages, and I'll just talk about a couple of them here. So to put the sort of national numbers into perspective, there are about a little less than 70 million single-family homes, 22 million single-family rental homes, and about 19 million multifamily units. And if you look at these charts, it gives you the impression that there's an issue, but there's not necessarily a crisis. If you look at the chart on the left, what you'll notice is that cost burdens for single-family owners have actually come down over the last decade. And why would that be? Well, the main reason is because of low mortgage rates. If you look at a longer time series, though, you can see that burdens have remained pretty high. And if you go back to the American Community Survey, on which a lot of this data is based, these are the highest levels we've seen in that survey. And there's another slide in the deck, which I won't go to, but everybody knows that costs have been rising faster than incomes. Incomes are starting to catch up a bit, but that's a fundamental issue. And you combine with that increasing construction costs, and so it's difficult to create. The single-family housing industry has not been creating the amount of supply that's needed. The multifamily industry has been creating supply, but not necessarily where it's needed, and you'll hear about some of the efforts to do that. But the real story here is actually looking at not the percentages of the population, but the numbers behind them. So if you see that there are people who are severely rent burdened, spending more than 50% of their incomes on housing, how many people is that? Well, it's about 17 million people. 17 million people are spending more than 50% of their income on housing costs. If we go to the next slide, very low income people, that's between 0 to 50% of area median income. That population of people is, if you add it up between owners, single-family renters, and multifamily renters, is about 25 million. 25 million households, or about 22% of the households in the United States, which is a shockingly high number. But if you look at the chart on the right, the national average, and it varies from market to market, obviously, but the national average income for a renter household is $19,472. And if you're spending 50% of your income or more of your income on housing, that means you have $811 a month for everything else. Those numbers are frightening. And so I think that it's easy to get sort of blinded by lowest unemployment rate in 50 years and some of the things you hear coming out of Washington. But there are a lot of people that are really suffering and have been left behind. So, I mean, that's kind of it's not a crisis in a percentage if you just looked at raw percentages, but it is a really, really serious issue, and it's the worst it's been in over 2 decades.
That's great perspective. In real terms, things have gotten worse for sort of the have-nots in our nation, and it's and forums like this where we can actually bring these things to light. So thank you for that, Hugh. Another question I'll follow up with is, Fannie Mae is a major contributor and has been for a long time in our space. Talk to us a little bit about what Fannie Mae's priorities are and what you guys' focuses are going forward.
So we are, I won't give you too much of a history lesson, but we were created in 1938 after the 1934 Housing Act. And back then, I think housing values in the Great Depression fell by about 75%. In the last recession, the average was, the Great Recession was a decline of about 25%. And our mission is to keep the cost of ownership and rental low by providing a liquid secondary market for mortgages. People will make mortgages, will buy them, will turn them into securities, using the global bond market to, buy our interest rate risk. And in the last 3 housing acts, what was added to our charter very specifically was that we are supposed to promote access to credit and increase the affordability of housing. And in FIREA, which was 1989, it specifically recognized that we acknowledge that the return on those activities will be lower than our other market rate activities. So there's a cross-subsidy between the credit that we extend to the broad market and the credit that we extend to people at the lower end of the income spectrum. The issue that we've been grappling with is that it does not seem that the supply is being created in the places where it's needed most. And there are a lot of reasons for that. In some cases, there are restrictive building codes. There's a shortage of land. There are creative solutions all around the country to how to deal with this problem. If you went to Atlanta, if you went to Cincinnati, if you went to Baltimore, if you went to Detroit, if you went to Philadelphia, and come to New York City, you would see examples of that. We're in the process right now, as announced last week, we'll be financing the renovation of approximately 1,900 NYCHA units. Now that's 1,900 out of a really gigantic portfolio, and that will be a long-term project. But for us, our pivot has been away from increasing the size of the credit box, because the very worst thing you can do is put somebody in a home they can't afford. You ruin their lives. There were 5-6 million people who were foreclosed on during the crisis. We modified almost 7 million loans to help people stay in their homes. But the destruction of their credit, of their family life, if they face foreclosure and eviction, is something that's really hard to recover from. So what we've been trying to do more is see if we can put our capital to work, whether it's through the LIHTC market or some of the other programs, bond enhancement programs that we have. If we can put our capital to work to help add to supply where it's most needed and where private capital is not necessarily flowing in the way that it might. An example that probably doesn't resonate in this room, but if you've ever tried to do a LIHTC deal on an Indian reservation, it's really hard to do. But that's the kind of thing we're leaning into, because that's one example of the type of place where it's really, really needed.
Excellent. And I'll challenge you guys to help us think this thing through as well. I was really inspired by the keynote address when he made the comment where, our focus should be on where are things working well, and let's do more of that. And so the markets that he mentioned, Atlanta, Detroit, these places, study these things for yourselves and figure out what are things that are working. We've had a great tradition in this nation of finding ways to incentivize the production of affordable housing via the credit markets. Maybe you guys can help us to figure out how to make wake the equity markets up, as he was saying. How do we get private equity capital more into this industry and get it to work? I have some ideas, but it'd be great to talk with you guys about how to continue to do that. We're gonna switch gears a bit. We've talked about the capital marketplace. We talked about the credit markets. We've talked about what Fannie Mae is doing. What we have before you is both a private and a for-profit and a nonprofit developer affordable housing. And we're going to start off with Lauren to talk a little bit about Jonathan Rose's platform for affordable housing. And Lauren, if you could, Talk to us a little bit about now. Jonathan Rose is a leader in green development, but also has done a lot in terms of planning for cities, done lots in the way of new construction and preservation. But because of their accomplishments in preservation, we're going to have her talk a little bit about the role of what we call preservation in the production of affordable housing. Preservation meaning taking existing assets and retrofitting those assets to repurpose them for affordable housing. So Lauren, what would you say is the role of preservation in affordable housing?
Great. Thanks for that. So, as he said, I'm with Jonathan Rose Companies. We've had a long history of new development, mostly in and around the New York City area, but kind of up and down the East Coast. And for a long time, we've been focused on developing green, affordable housing. It's really been where our passion is. And we've done a lot of that in New York, in other cities, and I think maybe you'll hear a little bit more from Muzzy, but development is a long, slow process. And so best case scenario, if we can, start, building a lot of affordable housing, we're maybe gonna, as he said, keep up with the existing stock that's out there. So in the last few years, we've really not shifted focus, but expanded our focus to affordable housing preservation. As Hugh was saying, there are 19 million affordable housing units out there, but that's shrinking. As contracts expire, people are tearing down affordable housing or turning it into market rate housing. We took a look at this market and said there's an opportunity there for us to buy properties and extend their affordability contracts. By doing so, you're able to sort of keep people in place when gentrification's happening by keeping that affordability covenant on an existing property. And there's also demand out there for it. And we'll talk a little bit more about the role of impact investing. But what we've really found is that there are pools of capital that are looking to deploy their funds in things that their clients are demanding. So social impact, environmental impact. And the role of preservation in affordable housing can really satisfy this need. The other thing I'll say is affordable housing is a fairly stable investment because if we think about the risks associated with an economic downturn, well, the demand for affordable housing only increases in that case, where luxury rentals may be experiencing vacancy. Affordable housing just has increased demand and stable occupancy. Plus, you have these long-term sort of covenants or contracts with usually a local or federal government that mean you have a stable set of income. So we find that affordable housing is a stable, sort of somewhat de-risked investment. And so what happens in the affordable housing process for us, we look at an acquisition, and typically there's an opportunity to extend what's called LIHTC, the low-income housing tax credit, and get caught up there. So typically that's a 20-year contract, and it enables you to infuse a property with a lot of capital investment. We approach that with typically kind of two pillars of what we're trying to achieve. The first is our green goals. So we look at the opportunity to renovate or rehab an existing property, and we take that opportunity to make it greener, more energy efficient, healthier place to live. And one thing, we've talked a little bit about the cost of rent itself. One of the other major costs that low-income families are experiencing is the cost of their energy. Many low-income households spend up to 25% of their income on their energy costs alone. Add that to the 30, 40, 50% that they're spending on housing, and what's left over. There's a recent study showed that of those households, About 40% of them at the end of the month are foregoing food or medication in order to pay their utility bills and keep the lights on. So we look at these major renovations that come as a part of a housing preservation rehab as an opportunity to help lower those lower those utility bills for our renters, and that's been a tremendous opportunity. The other sort of pillar that we're looking at achieving through our preservation work is around social impact. And on that front, we've designed a program called Communities of Opportunity. We really think that housing and where people live shouldn't be detrimental to them, but it should create opportunities for them to get on equal footing with those out there and to get healthy and get education and get all of the services that they need to reduce the stress in their lives, that sort of background trauma that is often occurring for people of very low incomes, and provide the support that they need in order to advance elsewhere in their lives. And so we introduce kind of physical infrastructure, fitness centers, community rooms, walkable facilities that promote health, promote community, and then we introduce social services as well. And Muzzy will speak to you more about this because they're doing kind of even deeper work in it. But you know, we partner with local nonprofits to bring in food banks and education, job training, all sorts of services that can help. And so we really see preservation as this opportunity to take the affordable housing that's existing, make sure that it stays there, that their residents have an opportunity to exist in the place that they've lived for a long time, and have it be a better place than they saw originally.
Wonderful. And I would tee it up a little bit, should have teed up preservation a bit more in terms of preservation versus new construction. One of the things about preservation is that because the assets are already existing, the construction period tends to be a little shorter because sometimes they're already cash flowing, the risk profile is a little bit lower, and they can be capitalized a little faster, and we can get those, what we call units. It's kind of an industrial way to think about it, but we call, you know, to move things along, we call them units. Get those units to market faster. Preservation tends to be a way to do it a little faster and try our best to meet demand. I'm going to ask you also, Lauren, in terms of, have you found private investors, you can talk LIHTC investors or private investors, are they accepting of lower returns than they would get elsewhere in the marketplace? Or, you know, how have you found those conversations when you're trying to attract, you know, capital? You know, we're focusing on the capital framework because we believe, at least I believe, on the moderator, you have to listen to me, sorry, that the capital marketplace is essential for sustainability and for the production and for us to actually do something about what we're trying to accomplish. So we have to be thoroughly integrated into the capital marketplace for that to work. So we need to understand those dynamics and how it works and how to make these investable investments. So you can talk a little bit about that. That'd be great.
Good one, sure. Yeah, I should say, and I think you mentioned it, Jonathan Rose Companies is a for-profit affordable housing developer, and sometimes that can be a dirty word in the affordable housing world. But our president, Jonathan Rose, really has structured it that way and always wanted it to be that way because similarly, you know, we believe showing that there's a business opportunity in doing good and doing the right thing is really one of the only ways to make these types of investments and the type of change needed at a national and global scale at the pace that we need it to happen. Altruism will get you, you know, a ways there, but showing that there's a business opportunity can really kind of accelerate the markets. And so that's where we focused. And I think that what we've found over the last year or two as we've been especially expanding the acquisition, investment, and preservation work that we're doing, is that there's real demand out there in the impact investing world. I think it's about a $250 billion market, which is really small when you're talking about capital markets, but it's growing really rapidly, this world of impact investing. And it's driven by a lot of factors. Lots of people say millennials are coming in and they want to put their money, behind the causes that they believe in. You also see a lot of endowments or pension funds that are responding to client demands, that they put their money into good causes, not just the next, tobacco company or oil company. And so you actually see a lot of capital pulling back from those types of investments and committing to impact investing. The city of New York actually just a few months ago changed the covenants around their pension fund, so that they would be pulling back from all fossil fuel investments and dedicating a portion of the pension fund to investing in clean energy and responsible investments. So I think we're seeing a tremendous shift in the impact investing world. And recognizing that, we saw an opportunity to help catalyze investment in affordable housing. And last year we closed a fund that was almost $250 million of private equity from institutional investors, endowments, pension funds, people really looking for impact. And so we were able to attract that capital. Your question about are they willing to accept lower returns is an interesting one. I wish. I'd say what we're really seeing from our investors is a demand for sort of equal returns as what they'd get elsewhere. We're targeting a 9 to 12% IRR, which I think is really competitive with what they're seeing in other areas of their portfolio.
Gross or net?
I don't know.
It's got to be net.
So anyway, so what we're seeing there is some solid returns, and what I would say also is what we really are seeing here is what we see a lot from our investors is they're looking again for that stability, and I think we may not be topping out and shooting for the stars, but they're really sort of reliable returns. And so we're seeing a lot of that. And I think, as I said, they're looking for that impact as well. So I will say, before anyone ventures into the impact investing world or this impact space, there's a lot of reporting that goes along with it. And some of that's new. In the environmental space, it's fairly well defined, but in a lot of the social impact work that we're doing, we're out there working hand in hand with our investors to understand what those metrics are that we should be chasing, what we should be reporting on, what do they want to see, what do their clients want to see. And it's a little bit of the Wild West right now, with a lot of people saying that they're creating impact. But it's tough to kind of ground that and figure out what's true. So when it comes to impact investing, I think you really need to kind of work hand in hand with your investors to understand where that focus should be.
Awesome. Thank you, Lauren. We're going to switch gears and talk about the nonprofit development approach a bit. And we have one of our city's best on terms of Muzzy Rosenblatt here to talk about what he's doing with BRC. The nonprofit development community actually goes a little even deeper in terms of trying to meet the community's needs in terms of offering actual social services to specific populations of people who need services to live their daily lives, from homeless veterans to general formerly homeless to people that are living with a physical ailment and the like. So Muzzy, I want to turn attention to you and just give you a very broad question about the nonprofit development approach.
Thank you, and thank you to the Tamer Center and Columbia Business School and the Social Enterprise Conference, not just for putting this on, but for recognizing the role of nonprofits and that we can be both entrepreneurial and have impact. And that is something that we think a lot about at BRC. It's not just what we do, it's how we do it. And our approach to this and to creating this, this building behind us, which is up and running now. Downstairs, a 200-bed shelter for homeless individuals. Upstairs, 135 units of low-income housing, 111 studios at 30% AMI, 1 bedrooms and 2 bedrooms at 50%, 60% AMI. So 2 things drove it, Mike. First slide, okay, is the people we serve. And so we run homeless shelters, we do workforce development, we do a whole array of services we'll talk about in a little bit. But what we're trying to do is not just shelter people, we're trying to help people achieve their goals, achieve their potential, and move forward with their lives. And the greatest challenge to that has been not our clients who are doing everything right. This is Stanley. He fell on hard times, he made some mistakes, he owned his challenges, he dealt with them, he found a new way to work. And he's actually been working at Fresh Direct for quite a while, as so many of our clients are. But at the wages our clients are making at $20,000 to $24,000 a year, at 30% of their income, right? So we're talking about $6,000 a year is what they should be spending on rent, $500 a month. I don't think I need to tell anybody in this room how easy it is to find housing if you're an individual at $500 a month. And so what's driving that is an ever-growing, next slide, increase, this vicious cycle in the shelter system. So I think many, if not all of us, are local. Welcome. And we know that there's homelessness is rising, but part of what is driving homelessness is this vicious cycle. That is longer lengths of stay. So if you're doing everything right, like Stanley and our clients are, but you can't find a place to go, you're going to stay in shelter longer than you need to. And so length of stays in shelters are going up. They've gone up 25% just in the past 4 years. And the rates of recidivism as people move out to opportunities that are more challenging is that they're coming back. So even as we're getting less turnover capacity, that gets reduced again because the turnover capacity is going back to the people who used it before, not because they did something wrong necessarily, but because the opportunities they pursued didn't work for them, and so they were coming back. So we wanted to break this vicious cycle. That was the first thing. The other thing we wanted to do was, I think it's really important for every business. I run a business. We're a nonprofit, but that doesn't mean lose money. That's not the business model. And even more challenging because public dollars are scarce and competitive, and philanthropic dollars are scarce and competitive, is how do we maximize the impact of every dollar we get? Next slide. So much of the work that we've done over the years, we've been in New York City for 50 years, is we're renters. We're poor, you know, and so we're not owners. And what does it mean when we rent? It means that we get reimbursed our costs. We have contracts in philanthropy, and we use our revenue. It's our second biggest expense. Our biggest expense is personnel. It's 65% of our budget. Our second biggest expense is rent. It's 20% of our budget. Our budget's $90 million, so we're spending about $18 million a year on rent. Are we getting everything out of that we can? Well, yeah, we're getting a place to do what we do. And so what are we doing when we pay rent? We're paying the cost for acquisition of the asset. We're paying for the debt service to finance it or whatever. Not ours, though, the owner's. So we're financing the owner's debt. We're creating an asset for the owner. And then on top of all that, because the owner is a profit maker, is we're giving the owner profit. And we were like, well, what if we were the owner? And so this is a typical shelter contract for a 200-bed shelter. It's mostly service dollars, like I said, but about 20-25% of it is rent. So 200-bed shelter, and we have one that we rent from a landlord, good guy, nice building. We pay $1.85 million a year rent. But of that, break it down, about 1.4, about 1.45 is the costs, and about 400K is the profit. As a nonprofit, if we have surplus income, we've got to reinvest it in our mission. And so that's what we did. We wanted to break that vicious cycle we talked about before and use that surplus income, that profit, instead of it being a profit that leaves us and goes and accomplishes something else, to reinvest it in what we do. So basically, what we've done is on the same site where historically a private developer would have built us a box, we would have rented it, we would have done our good work, we would have felt great about it, and that would have been it. We bought the site, we financed the debt, we acquired the asset, We built the 200-bed shelter, but we also had enough left over to cross-subsidize 135 units of housing for extremely low-income people, which means that we reduce length of stay in shelters, because now we have an exit plan for our clients, which means we've got more turnover, and so we can begin, which is the next slide, taking that vicious cycle and making it virtuous. And if we take this model and we replicate it over time, and we'll talk about that in a minute, I think there's great opportunity to scale this up for the city.
Wonderful. And we're actually getting close to 15 minutes. We want to give you guys 15 minutes for questions, and we're ending at 10:50 sharp. So what I'm going to do here is pick up my questions and ask a final question and get you guys open. Tee up your questions, because this is about you guys, not about us. Talk a little bit about, the final two questions I had was the role of new construction in meeting the social agenda, and also types and trends in support of services. Which of the two, I'll give you the option, which of the two would you?
I didn't hear the first one.
Oh, sorry. The role of new construction in meeting the social agenda. We talked a little bit about preservation already. So new construction, which is what this wonderful project is here. How is new construction meeting the social agenda?
So let me take that first one, and I'll go real fast, right? So we don't want this to be a one-hit wonder. We can't do it ourselves. We definitely plan to replicate, so we've actually started a fund, a working capital fund called the Way Home Fund. We've raised about $4 million, actually just over $4 million in capital.
That's wonderful.
Including $2 million from Chase, $1 million from the Keenan Charitable Trust, and others as well. You're welcome to join us. And the idea is to have that capital to make us competitive, to compete with private developers, to acquire land, to be nimble. When we get to financing, we recapture all of that with the financing. We reinvest that in the next site. So it becomes a recycling fund that can create a pipeline of projects. So a one-time investment in the fund enables a pipeline of projects to continue. And that's what we're trying to do. But we can't do it alone, so we're trying to get other nonprofits to do it. So think about the shelter system in New York City. 60,000 people live in shelter on any given night, point in time. It's closer to 150,000 people over the course of the year who move through. About a third of that is the old model. Nonprofits like BRC renting from private owners, about 20,000 beds. So our 200-bed shelter leveraged 135 units of affordable housing. Let's say we didn't do just our 200-bed shelter, but the city did the 20,000 beds that are rented from private landlords. That could leverage using existing. This is just replacing capacity that you have, using the current spend that is paying rent, and instead doing this, you could create 10,000 units of low-income housing for extremely low-income New Yorkers and make a huge dent in the affordable housing crisis in New York. So that's the trend. That's the trend we want to see happen.
Excellent. And also, we'll try the last one as well. Just any notes you'd have on trends in social services, like what are the populations that you're looking to reach the most?
Sure. Homelessness is a crisis for a person who's in the situation. There's no ifs, ands, or buts about that. Poverty, racism, and all those things that you were talking about before, they're endemic. They're not going to go away. We don't want them any more than we want people to be sick. We're always going to need shelters. We're always going to need hospitals, even as we try to find improved prevention and sustainability. By the way, it's a green roof on top. Green roof.
I see it.
But if we can bring services, an average care day at a BRC shelter, because it's rich with services, is more than an average care day in the shelter. But the number of days that a person spends in a BRC shelter before they move to a successful outcome because of those rich services is about a third less than the citywide average. So we have a privately funded workforce development program, as an example. It costs $2,500 for a participant like Stanley to be in that program. As a result of that program, people stay 135 fewer days in shelter than they otherwise would in the citywide average. That saves the city $12,500. So that's a 5-to-1 or a 1-to-5. I don't know how it's done. You're the finance people. Return on that investment, right, that saves the city money. And so the problem is that the way the city structures things right now is that they pay for effort, they don't pay for impact. And they don't fire the bad performers. And so we're getting more done than the average, and we're not the only one. There's a lot of us above average, and there's a lot below average, and there's a lot of mediocrity. And we could accomplish so much more if we demanded and created an expectation, just as we would with anyone who worked for us, that it's not the effort alone that matters if it's not having an impact.
That's right.
And we've got to move in the direction of demanding impact.
That's right. And we need you to demand that impact. All right, we need the public to demand that impact. We got about 10 minutes for questions and answers, so we'll open it up now. What are some of the questions from the audience? Mike up front. Sorry.
Okay, I get to be the first one. Great.
Is it on?
Is this on? Yeah?
Okay, good.
Great. My name is Gayle Foster, Morningside Play Care.
Hi, Gail.
Is my educational program. So one of the things that I'm a teacher entrepreneur, okay? So one of the things that challenges we're facing is that when we want to get space for a school or an early childhood program, we hear about this housing that's available that developers have where they have to do a community service by allowing some of their ground floor space to be available for some kind of social good. But we are operating through real estate agents. We're not able to communicate directly with these owners who might be inspired by our vision and our wonderful social enterprise. And so I guess I'm wanting to know, how do, non-MBA people, non-business connected people who want to do social good access the real estate opportunities that would be available through people who want to see their space used for social good?
I can talk a little
Sure.
bit about it. All right, so we, as I said, mostly we at Jonathan Rose Companies are in New York City developing ground-up opportunities. The way we get access to this, because as I'm sure you can imagine, land in New York City is very expensive. So we're typically going through an RFP process with the city, responding to their desire to build affordable housing. So an example of a project that I didn't mention earlier, but we are working on in East Harlem. It's a full city block, and we're going to be building about 660 units of affordable housing. In order to win this RFP, we put together a team that included not only development partners, so we have another for-profit developer that we're working with because it's a large project, a nonprofit development partner that we're working with, but also community partners. And so the way those relationships were formed kind of happened very early on. And so we're, as part of this development, going to be building a public charter high school. We'll have a daycare center. We have a nonprofit arts partner. And for us, at least, some of those were existing relationships. We'd helped build a school in the past, the middle school for this charter school. Now they're expanding and want a high school. So some of those relationships started early on, but some of them started kind of through this RFP process as we were looking at that community and talking to folks about what sort of services were needed on that particular block. What didn't those residents have access to? What would help? Who's already working in that area and may need more space? During our RFP process, before we were even selected, we were having those conversations about who needed space. And so we're really excited about all of the first and second floor programming that we'll have there, because we really think, I should mention we also have Mount Sinai, a health clinic for Mount Sinai. And so we were really excited about that opportunity to kind of take all of these services and bring them at scale to this community. So I don't know if that's a great answer, but my recommendation to you is keep an eye on what the city's doing. Try to talk to your brokers and understand what sort of new developments may be coming up. Again, that's a really slow process. We won this RFP in 2017. Nothing will be open until 2021 probably. So that's a long timeline. If you're looking for existing space, you'll have to, I don't know if you have other recommendations on that, but I would say you'd have to talk to your brokers or sort of maybe even knock on doors to let them know that you're there, because developers have their own networks, and it can be, they're often looking for tenants. That's a revenue stream for
Just
them.
look for a sign with a number on it.
Yeah.
Right.
Just look for a sign with a telephone number on it in a space that you want, and pick up the phone.
Yeah.
Or take our cards after this. We can follow up with you on that. All right.
Okay.
Excellent.
Thank you.
Absolutely. Just one more question. So we'll do just one more question. We'll be here available for questions afterwards.
Thank
Ma'am?
you. Thank you for the question for me. Good morning. My name is Chen Yan. I'm from China. Yes.
Good morning, Julian.
Chen Yan, yes.
Good morning.
And I work for China Global Philanthropy Institute. It is an NGO for philanthropy training and research. I am a social policy analyst, and I enjoy social impact bonds for the sick children in a city. We design the plan, and during this design process, I have some questions, but I want to know, according your experience, what is the most you concerned, whether it's the return interest or the social impact?
So what is the, could you ask it once again?
What is the most you concerned,
most of concern?
whether the return interest or the social impact?
So what's more important, the bottom line or the first line or the second line or the third line, I should say?
Well, I think that, as Lauren was saying, the social impact world is still developing rapidly, and it started with negative screening on public equity portfolios to screen out tobacco, screen out firearms, screen out things that people, fossil fuels, things that people thought were bad, and actually all it did was lower the prices, and then somebody else would buy the stock. So I'm not sure what it did, but I think what Lauren said is right. There's not a big universe of people that will accept a lower rate of return to achieve social impact. People want their cake and eat it too. They want to have the social impact and get the returns that are not that different, maybe a little bit lower than market rates, so that 9 to 12%, if that's a net return, might be a little bit lower than what a pure market rate private equity fund might be going for. But I would encourage you to approach any of these investments with a view that you're going to generate a return, because this is no offense intended, capitalism works. and if you can get private capital flowing into, whether it's from some of your large investment pools that exist in China or elsewhere, if you can get those large pots of money flowing into these areas, it'll solve a lot of problems.
I guess the only thing I'd add is to try and when you're trying to attract that investment, is there is rate, and currently in the market, it's all over the place. But what we offer, or at least what I think what all of us are offering, is stability on the long view, right? So we may not be able to maximize the return that somebody else can provide in the short term, but the housing is going to be here. The need for the services we provide is going to be here on the long term. And so it may be a lower rate, but it's over time more stable. And to the extent that somebody's looking to have a diversified portfolio, we can speak to that side of it.
Wonderful. So,
Thank you.
absolutely. Thanks for that question. We want to thank Columbia Business School. We want to thank Michael Panarak for your work and putting this panel together. Gwen Schufer of the Tamer Center, WAVE. And thank you guys for all being here. Let's give our panel a round of applause, please.